the major ones we will be looking at during this course are the overall financial systems, including capital markets. Then we will look at foreign exchange related issues. Third would be project finance, and today you are aware that in India large projects, especially infrastructure projects, have gained importance. And finally we will look at mergers and acquisitions. All these topics are of course interconnected, so to some extent, I mean, these are major areas where we have divided them up into 4 of them, but there are cross functional issues and cross knowledge issues all the time. But we will use some of the information that we have already learnt in FM1 because they are the basics, but these are more applied using those basics. So let's start with capital markets and overall financial system. So before we get into the financial system, I've just given an introductory, a few slides in order to emphasize some of the issues involved. And today, what are the advantages and disadvantages of having a sophisticated financial system? So basically what a financial system does is it is a complex, well-integrated set of subsystems of financial institutions. We will see there are different kinds of financial institutions. There are different kinds of financial markets. There are different types of instruments as well as services which basically the financial system is operating. And the reason they are operating this is to transfer and allocate funds amongst the players involved, because the financial system has to transfer the funds basically from the savers to the investors. And what are the information mechanisms which help this transfer and allocation process? And because of this transfer and allocation process, the more efficient and effective it is, the cheaper it is, the more it can contribute to overall growth. So number one, financial system is a payment system for the exchange of goods and services. For example, if we issue checks on banks, this is a payment system basically. The pooling of resources for undertaking different types of enterprises. Pooling of resources, the capital market, the money market, debentures, shares, all these are pooling systems, insurance, in order to undertake or finance different types of enterprises. Transfer of resources leading to efficient allocation of physical capital. See, at the end of it, the financial system cannot exist on its own. It has to basically facilitate the investment in physical capital. Quite often we forget and we start doing, in fact in the world, finance for finance itself. Now obviously this will lead to trouble, as we have seen in the last 1 or 2 years. So basically finance has to be at the end back up the real sector. That is an important issue. Next is a well-developed financial system enables economic agents to pool price and exchange risk. It is important to pool the risk at one place, like an insurance. It has to transfer the risk to somebody who's in a better position to take that risk. And while we are exchanging risk, there must be a price which has to be paid. And who bears that price and how much price that is, it is important. And that of course is an area which derivatives deal with a lot. We will look at 1 or 2 areas of derivatives like foreign exchange, but that is what derivatives does. And it generates information which supports decentralized and efficient decision making. What it means generating information is I can sit at home today and access information which tells me the risk of a particular financial institution, the risk of a financial instrument. And how do I do that? In order to get an independent view. For example, you have credit risk institutions who analyze credit risk. So by having access to that information or somebody giving me that information, I don't have to understand balance sheets or financial statements, but I can do it just on the basis of getting that information. So these are some of the areas that financial system looks at, and some of these we will look at. So now, just to speed up what we have already discussed, is financial markets reduce the cost of transacting, including search costs and information costs. As I said, that it is easier today to access this kind of information, because if I spent a lot of time on it, then one, I'm spending the time without that knowledge, perhaps probably taking a wrong decision, and that implicit cost is the time and effort put in to locate a customer. In addition to that, I have to pay the fees of that information that I have accessed, or somebody has to pay the fees. Okay. Next is, often in developing countries, an informal system coexists with the formal financial system. As you are all aware that in India also you have these money lenders who basically support the formal financial system, but that system is much more deregulated and not under the control of the regulators. Finally, we say proponents of the finance market system argue that efficiency is associated with the functioning of competitive financial markets. This is becoming a big issue of controversy, is that today you have people who can access funds globally. Similarly, the global fund managers can invest or take out money freely. Now what is happening is, this is giving us access to an international or funds from a much larger group. But what it is also happening is that the funds which are very large and who can move from one market to the other can also withdraw money accordingly, which means it does get exposed to, we do get exposed to a lot of market risks, which has basically increased the risk of the marketplace. So large volume of transactions and the speed at which financial resources move from one market to another. Today we have what is called capital account convertibility. We'll look at that issue later on, which means basically funds can move between markets at the speed of light. You just punch a button and it's moved, which means that this kind of transactions are very fast, very reliable, but also they can be withdrawn. So there is scope for arbitrage between various markets and types of instruments. Scope for arbitrage meaning taking advantage of small movements. There are small price differences in different markets. People start taking advantage, which in the end leads to arbitrage opportunities. So that is one. Second, financial markets are highly volatile and widespread panic distress selling can take place. More and more there are very big players who have come in. So what happens is, supposing the share market is at a certain price and one or two people believe that the share market is on their way down, then they start selling. If they start selling, then there are what are called technical positions built up, which might force other people to sell. So a limited group of operators. Today what's happening is, some of these insurance companies, mutual funds, foreign institutional investors, there are insurance companies or groups of financial institutions which control $1 trillion. So you can understand, when these few people come in and start moving markets, the smaller fry actually are totally helpless, and the behavior of these groups of people can lead to panic and distress selling, and that thus governments then have to intervene to try and cool things down. That is one. And finally, as I said, markets are usually dominated by financial intermediaries who take investment decisions and as well as risks on behalf of depositors, investors. So we have got money in big banks, and the big banks, supposing they start failing or they start getting into trouble because of what we mentioned previously, that is, there could be widespread panic or distress. Then what happens is, the smaller fry who have got deposits in these banks, etc., run into problems. So you had the sight of big banks, whether it's Citibank or big mutual funds or big investment groups. They were all getting into trouble, and then thus we coined a term called TBTF, too big to fail, and thus governments have to come in and to try and save them. Now, so overall what we are seeing is, there is an efficiency of markets. We move globally funds, which leads to a lot of improvement in technology, thus improvement in the way we deal with funds, which is very good for efficiency. But it is also bad, or some of the effects are that we could get into trouble because of this, and thus the financial markets to some extent have become more risky. Of course, another thing that has happened is various fancy instruments have been introduced. Now let's look at this, looks at what are the various types of financial markets that there are. And these are debt versus equity markets. Debt versus equity markets are basically, debt is, as I said, loans, and equity is obviously ownership capital. So the nature of claims is one type of way we differentiate between markets. So that means either we raise debt instruments or we raise equity instruments. Equity instruments are ownership type of instruments, and debt of course is loans. There are some instruments which are a mix of the two. These are called hybrid instruments, like convertible debentures, which we will look at today. The second way we classify financial markets is money market and capital market. This we had seen earlier also in FM1. Money market are those instruments which basically mature in 1 year, and capital market instruments are those instruments where the basic instruments have a longer period to maturity than 1 year. So one way we differentiate is the claim maturity of the claim. Less than 1 year is money market, more than 1 year is capital market. For example, in India, money market, the regulator is Reserve Bank of India, whereas in capital market, the regulator is SEBI. Now, the type of claim that we get into, the next one, is primary market and secondary market. Primary market is where the initial issue is made. So if a public issue is made, or the first time shares are issued, that is the primary market. Secondary market is when we trade in those instruments. So whether it is a debt instrument or a equity instrument, it is issued in the primary market and then traded in the secondary market. But both are important, because I will not buy the share of a particular company in the primary market unless I know I can get rid of it in the secondary market. Similarly, the secondary market cannot exist if the primary market was not there. The fourth way we do it is called timing of delivery, that is spot or cash or spot market versus forward or futures market. What we mean by this is that, are we doing the transaction today, or are we deciding on a transaction today which we will carry out or consummate at a future date? So the financial markets have this great advantage that you can decide on a price in the future today. Thus the future becomes less uncertain. So we have got a timing of delivery, and finally we have a system called exchange traded versus over the counter. Exchange traded means when we do a transaction, we do it on a platform which is common to everybody, which means it is regulated. Whereas over the counter market is a deal done between two people. It could be a bank and an individual, or an individual company and a bank, or two individuals. But an over the counter market is unregulated but done between two people on one-to-one basis. So today the belief is that more and more we should do transactions on an exchange traded basis, because then a regulator or that platform which is regulated will then have more controls, and the system would be subject to less risk. For example, in the so-called mortgage derivative problem that we have had in the recent past, the real problem is not on the exchange traded instruments, but the real problem has been on the over the counter or OTC instruments, because the risk taken by the participants were too much. So this, I think, is a decent way of dividing up the different types of markets. So just go through this. Is an important slide of how we start understanding markets. Okay. Now the next issue, we will discuss some of these issues involved. One is interest rates. What is interest rate? Interest rate is, you could say, the price of money, which is decided. Uh, no, Pavan, OTC is not illegal in India. In some of the cases, it is not allowed. For example, when you are dealing with the share market, out of the market transactions are not allowed unless under special circumstances. But for example, in foreign exchange, you can do an OTC between a bank and an individual or a company, which is allowed. So over the counter is not illegal, but in certain instruments, it is not there. Uh, Venkat, equity is unsecured. There is no security of equity. Uh, the only security you have that after paying off everything else, if it is available, then it is there. Okay. Interest rates, as I said, is basically uh, the price of money, and the interest rate is a rate of return promised by the borrower to the lender. The interest rate return depends upon a variety of factors, including the unit of account. What we mean by the unit of account means the currency involved. For example, if it is in US, the interest rates are different. In Japan, it is different. In India, it is different. The reason they are is, one of the reasons there are, is because the inflation in different countries are different. So that also is complicating global movement of funds. We will look at this aspect later on. But so the unit of account is important. Maturity, usually, and I repeat usually, the long-term interests are more than short-term interests because the period that you are lending the money for is longer. But sometimes you could have a situation where short-term interests are more. Sometimes when you go to a bank, you will find the bank is offering shorter term interest is more than longer term. The reason is that they expect the interest rates to start moving down over a period. So they're offering interest rates which is not a typical slow rising curve, yield curve, but it is what is called a J curve. So the maturity is usually important in determining interest rates, and usually long term interest rate is more than short term. Ram Gopal, this is not really fixed or floating. Floating means basically that you can adjust the interest rate depending upon how interest rates are moving. Fixed is there. But what we are saying is that even if it is fixed, the person, let's say a banker, tells you, if you put a 6-month deposit, I'll give you this interest rate, 1 year I'll give you so much, 2 years I'll give you so much. Usually the interest rates are rising. But sometimes what happens is, depending on the position of the marketplace, a bank could say that I'll give you a higher rate of return for the shorter period, but give you less for a longer period. This is not a typical situation, but it can happen, especially when there is expectation that later on the inflation will go down. Okay, next is rate of returns on equity. In the case of equity shares, the rates of return are two: the cash dividend and capital gain or loss. Now this we looked at last time, but I have given a simple example that when we consider return on equity shares, we have to consider both. And what are they? We have to consider the return on cash dividend, and we have to see capital gains. This is important in the sense that quite often the taxes on the two parts are different. So what is the return that you get on equity shares? Supposing you buy a share of a company's equity at a price of rupees 100, after 1 year you get a dividend of rupees 5 and the share price rises to 115. So what we have got are two parts: 5% as dividend and 115 minus 100 divided by 100, that is 15% on capital gains. Now usually, like for example in India, in cash we pay a dividend tax, which means that the company pays the tax on our behalf, but basically the tax has been paid. Whereas on the capital gains part, if we sell the share, then if you hold it for a year, the capital gains becomes nil. So when we are looking at 5 plus 15, 20%, this is fine, 20%, but we'll have to see what the taxes are in order to get a final answer. Okay, next is let's go to slide 8. Inflation and real rates of return. This I just mentioned earlier to you, that to make meaningful economic comparisons over time, the prices of goods and services should be corrected for the effects of inflation. Typically, as inflation rises, interest rates rise because the difference between nominal and inflation rate is the real rate of return. For example, today already there is a threat that as inflation has risen, the government would try and raise interest rates, or the RBI will try and raise interest rates in order to cool down the economy. There are two issues involved in this cooling down process. One is, when you raise interest rates, people who demand interest rates will borrow less. If they borrow less, they might invest less, which means you are trying to slow down the economy. But the government really doesn't want to slow down the economy, it just wants to slow down prices. But what happens is, it is very difficult to differentiate between the two. When you are trying to slow down prices, you also slow down rise in prices, you also tend to slow down the economy. On the other hand, the people who are putting in money, depositors, get encouraged to deposit more if the interest rates rise. And because they're putting in more, that is, their deposits are increasing, their savings are increasing. If their savings are increasing, then consumption also comes down. If consumption comes down, then obviously production comes down, because consumers will demand, or consumers can consume only the goods produced. Now, if they are demanding less, then obviously the production will become less. So when you raise interest rates, that has various effects. So to make meaningful economic comparisons over time, the prices of goods and services should be corrected for the effects of inflation. Similarly, a distinction can be made between nominal and real rates of interest. The principal factors that determine the rates of interest in a market economy are these: expected productivity of capital. As economies mature, we tend to use resources which are saved by others, and the higher the return that we can give on that investment, the more that we can pay the people who have given us the money. So productivity of capital, capital resources comprising tangible capital and intangibles, and help in producing goods and services. All this determines partly the returns that you are giving for the money that you have collected, both in terms of interest, of course, and as well as other returns. Now, degree of uncertainty characterizing the productivity of capital. In general, higher the degree of uncertainty about the productivity of capital, higher the risk premium required by investors. The more risky the investment, this is the risk return trade-off. The more risky the investment, the more the return that we will be expecting. Then we said time preference of people. People prefer current consumption to future consumption. Other things being equal, the greater the preference of the society for current consumption, the higher the interest rates in the economy, and vice versa. Because as consumption goes up, the savers have less ability or interest in savings. So the people who want to get their money have to raise interest rates in order to cool down current consumption, in order to encourage people to save. And the degree of risk aversion, the financial system splits the uncertain return of capital into two broad components: a risk-free return earned on debt securities. Of course, debt securities are not totally risk-free, but the base is a risk-free instrument, and after that you load on. But the real risk return is earned on equity securities. And if you remember FM1, the return on equity shares in India has been around 16 to 18%, with variance and standard deviation being quite high. And that is what is being mentioned here. Now, at the equilibrium price means price of interest, the supply and demand of loanable funds are matched. Now, theoretically, this is the theoretical position, that the price of demand and supply of money is the interest rate. So at a theoretical basis, at the equilibrium price, the supply and demand of loanable funds are matched. That is the equilibrium interest rate. However, interest rates are often not determined by market forces. And because there are people who dictate the interest rates to us. And what is the way it is dictated? At present in India, the savings rate of interest of commercial banks, if you go to the bank, the savings rate is determined by RBI. It is not determined by demand and supply. There are some loans to weaker sections which are determined by the government and the RBI. And the rates of interest payable on small savings, whether it is Public Provident Fund, NSCs, these are not often quite dictated by government, dictated by the market forces, but fixed by the government. So this sort of distorts the picture to some extent on market prices. So the major criticism against the administered market prices is that interest rates do not adequately perform the role of allocating scarce resources in an economy between alternative users. So the demand supply factor or the market forces are not allowed to operate fully. On the other hand, administered interest rates may protect vulnerable sections of society like the poor and the elderly, who also require, sometimes you call this interest subvention. That is, you support certain groups by giving them higher interest rates or charging them lower interest rates. This distorts the picture of so-called market forces, but it helps the so-called vulnerable sections. Of course, sometimes they're also misused by politicians because then they can hand out freebies, but that does not mean that the theory is incorrect. Now, what are money market instruments? Money market instruments are, a money market is a market for short-term debt instruments, maturity below 1 year. It is a highly liquid market wherein securities are bought and sold in large denominations to reduce transaction costs. The functions of a money market are to serve as an equilibrating force that distributes cash balances in accordance with the liquidity needs of the participants. So basically it is a short-term market to form a basis for the management of liquidity and money in the economy by monetary authorities, and to provide a reasonable access to the users of short-term money market for meeting the requirements at realistic price. But what is happening actually? This is of course the theory of it, and these are the instruments which are used in India in the money market. There are money market centers at Mumbai, Delhi and Kolkata, with Mumbai being the main center. As we are aware, the main financial center in India is Mumbai. So the most of the money market instruments, the basic transactions take place in Mumbai. Of course, they're all done electronically, but in Mumbai, the major players are there. So the big banks have their so-called treasury department. The mutual funds are mainly established in Mumbai. Reserve Bank is there in Mumbai. Headquarters of, or the treasury departments of State Bank of India. So the market in Mumbai, today you can deal with electronically sitting away from Mumbai, but people who are located there, they also know each other, they meet in the evenings, they talk to each other. So Mumbai is the main market, with Delhi, Kolkata, Chennai, etc. following suit. And what are the major money market instruments that we have? This is the first one, which is extremely important, treasury bills. Treasury bills in India, I think we had seen this earlier, 91 days, 182 days and 364 days. These treasury bills are issued by Government of India to raise short-term funds for use by the governments. This is the least risky government security, least risky in the marketplace. This sort of trend sets the trend for interest rates. So treasury bills market is a huge market because government keeps on picking up funds from various people, including banks. The next one is the call notice money market and short notice up to 14 days. This is the interbank market between banks, and big money changes hands because banks have to meet what are called cash reserve ratio and statutory liquidity ratio requirements. So they're required to lend and borrow from each other. And when they lend and borrow from each other, then this is done in the call or interbank money market. The other person who intervenes in this marketplace is the Reserve Bank of India. The Reserve Bank of India, yeah, Satendra, I've just not mentioned Chennai, but you have a money market even at other places like Hyderabad or Bangalore, but these are the big three. That is, Mumbai, followed by Delhi and Kolkata. Chennai is there, but then similarly there is Bangalore, Hyderabad, Ahmedabad. All the big places have some amount of transactions happening, but the major of transactions, of course, happens in the top three areas. Okay, so I've just mentioned that there are other places also which are there. Then, so in the call notice money market, the RBI also is involved. How the RBI is involved is that when the banks run short of funds in the marketplace, they borrow from RBI at what is called the repo rate. And if they have excess funds, they can deposit the money with RBI at what is called the reverse repo rate. So in this call notice money market, the other two basic interest rates which are used, you will keep finding in newspapers it is mentioned, is called the repo rate and the reverse repo rate. So the repo rate is the rate at which the RBI lends funds to banks, and reverse repo rate is the rate at which RBI takes deposits from banks for short term. So the interest rate messaging or information which is sent by RBI to the system to say what they feel the interest rate should be are done through what is called the repo and reverse repo rate in this call notice money market. The next three are commercial paper. Commercial paper is raised by companies in the marketplace maturing in less than 1 year. Certificates of deposits are bank deposits. Yes, Tejashree, you are very right. Repo and reverse repo rate has been hiked, and this is how RBI is signaling to the marketplace that they feel interest rates should start moving up. Because today interest rates are determined by the marketplace, so RBI cannot dictate the interest rate to the marketplace, especially banks. So what they do is, by giving an indication through repo and reverse repo rate, they are telling banks that interest rates would tend to move up, we feel, because inflation is tending to go up, and by tending to go up, it has gone up, and we need to cool things down. However, the RBI does not want to take the risk of moving the interest rates too quickly, because then that might unhinge the so-called growth that we are seeing in the economy, and we might go back to some 5 or 6%. So this is, so Venkat, the repo and reverse repo rate is controlled by RBI, because RBI is the monetary authority. So RBI sometimes consults the government. The basic decision has to be taken by RBI. Now, how these rates, they don't directly relate to inflation. What is done is that RBI is saying that interest rates should tend to move up, because the banks are going to see, the banks run short of funds because they might overlend. They know now that they will get money from RBI at more expensive rates, that is at repo rate. So RBI, if they are going to give amount to people at higher rates, then the message going out into the system is interest rates are on their way up. But it is not, it is a relationship, it is a direct relationship, but it is not a proportional relationship. So banks might still not hike their rates even though repo and reverse repo has been increased. But the message is clear that interest rates are now on their way up. The difference between commercial paper and commercial bill is commercial bills are used as a collateral. Collateral means as a security in order to borrow money in the short-term market. So commercial bills can also be used by banks of, that is commercial bills of a company which is being held by banks, which is being used as a security to buy and lend. But the main way, of course, that short-term funds are raised directly by the companies are commercial paper, and certificates of deposits are raised by banks. But please remember, these three, that is commercial paper, certificates of deposit, and commercial paper, especially commercial paper and certificates of deposit, are still much lower than these transactions which are taking place in treasury bills and call notice money market. But as our system becomes more sophisticated, more and more companies will start raising money from commercial paper. Okay, so these are the main instruments used in the money market.